Hello everyone and welcome back to another episode of the Money Garden. Today is Monday. You know it. We're going to talk about the next step in our 6 steps to financial independence. So once again, we are part of right now of the 6-week series that we talk about 6 steps of to financial independence. And let me review that with you guys very quickly. So again, step number 1 was cash flow, right? Step number 2 was debt management. Step number 3 was emergency fund. Step number 4 was proper protection. Step number 5 is building wealth. And step number 6 is preserving wealth. So today we're going to cover step number 5, building wealth. So with that said, what do we need to know about building wealth? Well, first we want to learn about how money works. How do we build wealth, right? Most of the time, the majority of people that when we think about it, I want to do what for the future. How do I make money in the future? Well, I save first, right? Save and then invest, of course, investments. Whether it's in real estate, whether the stock market, whether mutual funds, whether retirement accounts, whatever the case may be. But nevertheless, it comes with saving and investing, right? Now, if we just save, we can't really build much wealth. So, because if you keep it in the bank pays you what? Less than 1% in interest rate, right? So we have to, that's why we're always looking, we talk about what we call ROI. ROI stands for return on investment, right? So we're always looking, where can we get the best return on our investment, right? But then once we know the return on investment, so what? The interest rate, in other words. So whatever interest rate is the same thing as return on investment, right? But then what? The next step. So how do we calculate? How can we plan for the future? How do I know if I'm 20 years old or 30 years old and if I want X amount of money at 60? Well, how? Well, there is a formula, you guys, which is essentially the basics of how money grows. All the financial institutions from the stock market, everybody uses it. And it is something called the Rule of 72. Now, if you haven't heard of the Rule of 72, don't worry, because majority of people haven't. Probably over 95% of the people, when I talk to them or I ask them, I say, have you heard of the Rule of 72? And people say, I don't know. And that's not unusual at all, because it's not taught anywhere. Like in school, high school, college. Sometimes some of my clients say, well, okay, you know what, I didn't go to college, maybe that's why I don't know. And I tell them, don't worry, I went to college, even to grad school. I was not taught some of these concepts. So if you don't know what the Rule of 72 is, do not worry, most people don't. However, when I bring it up and say, well, what about compound interest, right? Most people are like, oh yeah, I know. But again, most people would not be able to actually explain it, how it works. So today, in the portion, in step number 5, building wealth, we're going to learn the Rule of 72, aka also known as compound interest. So, the Rule of 72, it is a mathematical equation. It was invented by Albert Einstein. And basically it says, it's a very simple equation that basically says that if you know the interest rate you are making on your investment, you can calculate how fast your money will double. How many years it will take for your money to double. So let me give you guys the actual definition, and then I'll break it down, and then we're going to break it down for you guys so it's easier to understand, right? So basically it says if you take 72 divided by the interest rate you are making on your investment or you're getting, equals the number of years it will take for your money to double. So for example, what does that really mean? So if you have your money in the bank, right, and what do banks pay nowadays? Most banks pay less than 1%, right? And they vary a little bit, but let's just be generous with the banks and let's say 1%, although Chase pays 0.01, for example, because I bank there. But let's say it's 1%, right? So then if you take 72 and you divide it by 1, equals what? Equals 72. So again, we're taking 72, we're dividing it by the interest rate, right, that we're getting. In this case is 1, we said. It will give us the number of years it will take for our money to double. So 72 divided by 1 equals 72, which means if you have $10,000 or $20,000 in a bank and you don't touch it, and for the rest of the time you continue getting 1% on it, that means for the $20,000 it would take 72 years for it to double to 40. Is that exciting? Not very exciting, right? So I want you guys to remember, if you're saving, that's fantastic. Congratulations. But make sure that you also educate yourself on how much should I keep in a bank, because there is a certain amount we want to keep for emergency fund, right? If you think back a couple of episodes, and the emergency fund needs to be liquid. But after that, you really definitely want to educate yourself, like, where do I put my money and where can I get a higher return on investment? Because, so let's say what happens now if you are getting 10% or 12%. Why do I use these? Because over time, so if you look at the analysis of the stock market started in 1934, right, you guys? So for example, from 1934 all the way to 2017 or 2018, on average, the stock market returned 12%, a little bit over 12% return on investment on average, right? We had the crashes and we had the highs and the lows, but overall, if you were to invest $10 in the stock market in 1934, overall you would have made 12% interest every year on it, right? So let's say 10. Let's say you find a place and you invest your money and you make 10% on it. So again, how is that the rule of 72 applies to it? Using the same parameters of $20,000, right? So now we take 72 divided by 10 equals what? 7.2. So now if you take the same $20,000, right, invested at 10% rate, right, that will give you 7.2 years for it to turn into 40. So a lot more exciting, right? I can wait 7 years for my money to double. And here is where the exciting part comes in, you guys. This money now, therefore, let's assume you never put another penny in it. It continues to double every 7 years, so long as you continue to get 10% interest or return on your investment. So therefore, in 14 years, this 40,000 is now becomes 80,000, right? In 21 years, the 80,000 now becomes 160,000, and in 28 years, the 160,000 now becomes 320, right? In 35 years, the 320 now is 640, right? And so on. By the time you're 40, now you can have about $1 million and $1.2 million. This is, we're talking long term, right, for retirement wealth. But essentially, this is what we want to keep in mind. It's how you build wealth. Understand the rule of 72. The rule of 72 says if you take 72, you divide it by your interest rate that you're getting on your money. It could be 4, it could be 6, it could be 8, I don't know. But the point is, if you know the interest rate you're expected to get on your investment, then you can calculate based on how much you put in it. You can calculate exactly in how much time, how much do you expect to have in an account, right? And by the way, the last thing I want to make sure here that I mentioned to you guys, and then we'll wrap it up for today, is that the same thing works in reverse on your debt. So if you have debt and you have about 29% interest on your credit cards or 15% interest, just be very careful. You can also immediately calculate that debt will double if you're just making the minimum payment. So if you owe $5,000 on a credit card and your interest rate is 29%, 72 divided by 29 will average at 30. That's about 2.3. So that 5,000 will double to 10 in two years, 2.3 years. And then now it's going to double to 20 in 2.3 years. So be very, very careful understanding your debt, because the rule of 72 works either way as long as you have a return on investment. In this case, the interest rate, it's a return on investment for the banks, for the credit card company, unfortunately, not for you. So hope that helps you guys. The rule of 72, aka compound interest. Make sure that you keep this in mind, and now that you know this, you are educated, and now you can figure out exactly how to build wealth. Well, thank you so much for watching. I appreciate you guys like always. Please like, comment, share, and thank you so much for watching, and I'll see you guys next time.